So I figured in this video, we'll look at charts because I do want to understand charts better. I mean, obviously I know how to read charts, but some of the more, advanced topics I never really looked into. So yeah, let's learn together on this, because I think even though I'm really about fundamentals, understanding companies that have good product, have a good service, make money, things like that, and I invest in the long term. If I could understand charting, maybe I could make money in the short term as well as the long term. This is NVIDIA, so this is kind of like the hot stock. And RSI is one indicator I like. It makes sense to me. I haven't really looked into other indicators, so let me know in the comments if there's an indicator you like to look at. Volume also is something that makes a lot of sense to me, because if there's a lot of volume, it does imply that there's some popularity with the stock, or maybe there's a lot of bearish interest in the stock. So it could be both ways, obviously. But generally, volume means a stock is either volatile or popular or something like that. And when a stock is volatile, then there's ways to make money on a short term. And you can't look forward. Like, I can't look at the stock chart in the future. It's impossible, right? Because nobody knows the future. But we could look backwards and maybe identify things we could have done to make a better investment decision. So NVIDIA, so you could see they were trading between 400 and 500 from way back from in June 2023 up through January 2024. So they weren't like blowing up, like constantly going up. I mean, it didn't really move. It traded sideways for 7 months. So there was opportunity, obviously, to buy it. Let's look at the weekly chart. It pulls back a little bit. I like candlesticks better than the bar chart. It gives a little more information. So right after COVID, a lot of stocks blew up, including NVIDIA. So this is 20. Yeah, this is back in March 2020. Okay, so this gives us the full picture. So it was well under $155 in March 2020, and then at the height of the COVID run, I guess you can call it. So that's at the end of 2021. It broke through 350, and I think a lot of people, including me, were like, this stock has to come down. This is way overvalued. And it did come down. But the thing is, when you think a stock is overvalued, like remember Tesla, a lot of stocks, we say, oh my God, it's so overvalued, it's so overvalued. But then when it comes down, we don't buy it. Because when it does come down, it was like, what, 350 almost at the end of 2021. And then it came down to about 100 at the end of 2022. But we still don't buy it. We could have bought it. We could have bought it when it hit 200, 250, 150. We could have bought it. We never bought it. There's always this mindset is that it's going to keep coming down. So we don't want to buy it. Just like when it goes up, we don't want to buy it either because it's going to keep going up. So you just have to go in at some point. You can't just keep waiting. Of course, if you like a stock on a long-term basis, I'm talking about, but on a short-term basis, so it was between 200 and 300 from the end of 2021 to the beginning of 2022, and then it fell. So the run-up didn't really start until 2024. So it was, and then it's just like this crazy greenness. I mean, you could have been a billionaire if you bought options. But let's do the monthly. Why is that? Where's the chart? They give you a chart where it shows you the earnings here, right here. Did anybody use FinViz? I like it. Sometimes it shows you like the earnings on the bottom or dividends. I don't really care about the dividends because they don't really pay much of a dividend. It's like, how do you get that to appear? Okay, I guess on the 1 year chart it does. So this is a helpful. It would be nice if they overlaid the actual revenue, so you can see like the revenue, how it moves relative to stock price. I'm sure it might do that, and definitely some websites do that. But this is, I mean, stocks generally move during earnings. So if you like to play options, there's a good chance the stock will be kind of flat for almost 3 months. It's when earnings hit is when the stock jumps, either up or down. So you can see this was their Q1 2023 earnings. So it was the period ending April 2023. And they did well. You know, they've been killing it every earnings release. So they beat earnings by 18%. A surprise means it was above what analysts thought. GAAP EPS even better, 36%. Revenue, they beat it by 10%. So they crushed earnings, and as you would expect, there's a huge gap up. So when I say gap up, that means there's no connection with the line. That means it closed at 305 on May 24th. This is in 2023, of course. It closed at 305, and the following day it opened at 380. I mean, that's a huge gap. So, and the way, I mean, 30, 40 years ago, there was no gaps like this. But now there's so much activity in post-market and pre-market trading that if there's a lot of activity, a lot of buying, like a lot of people push the stock price higher, it has to open at this higher price. Because if it opened at the price it closed at the day before, like if it closed at 305 on May 24th, on May 25th, if it opened at 305, you would have like inside information. So it has to gap up. It has to open at a higher price because of all this activity. We have a lot of information on post and pre-market trading. Paul, what's up? Yeah, my last few live streams, I lost a few subs. I think maybe when I talk about like financial statements, I think it's too kind of like hard for people to like follow, unless they watch the video from the beginning. So I'm going to try to talk about topics that are kind of easier to kind of like absorb in a shorter, like where people can pick up at any point in the video and see where I'm at. So I'm going to try to do charting, and this is what I did want to learn more about charting, because not that I'm a short-term or day trader, but I do want to learn everything I could about the market, because the more information you have, the better. Thank you, Paul. That's really nice of you. Paul's a new sub. Good guy. I appreciate the support. Whether it's monetary or just comments, it helps me, motivates me to keep going on this channel. So earnings, they beat it. They crushed earnings. It's an interesting thing. I know when I get off on these tangents, I know people stop watching. But this is kind of how stocks react. Let me see if I can articulate it. Somebody asked a question about goodwill, and then I was thinking I didn't answer it well. So maybe I'll answer it, because I think I have a good way to convey how goodwill works. Okay. So our company. Pretend we have a company, we want to acquire other companies. Okay, this is how goodwill works. Okay, we want to acquire company X. Okay, and then a new. Okay, our new company, which is post acquisition. Okay, pretend this. I think this is a good way to explain it, because I was sometimes it's hard to explain things. But anyways, I think pretend we're like a shell company, which is like what a SPAC is. A SPAC is when a shell company. Why does daylight savings time exist? Does the stock market benefit from this? I don't think it benefits from daylight savings. It was just a way to balance the day with sunlight, right? There are some places, I think, what's that place in California, in Florida? I went there for spring break, and they don't practice daylight savings. They don't recognize it. But it's just, I think, a way to balance the sunlight. So there's more sunlight. It kind of keeps the amount of sunlight in the daytime while we're awake consistent. But I think it's a waste, and they've been talking about getting rid of that. So just pretend we're a shell company, which is exactly what a SPAC is. A SPAC is a shell company that acquires an active business. And say the only thing we have is $1 million, and that's from our say me and you own a company, and then the only thing we have is $1 million of cash. That's the only thing we have. We're not doing anything. We just want to acquire another company. That's our only business model. Is we want to acquire another company and then run that company. So we find a company, it's called Company X, and we want to acquire Company X. Okay, and this is their balance sheet. They have $1 million of assets, and let's just pretend it's all property and equipment, because they make a product that we like. So we want to acquire them so we can make the product they make, and maybe make more of it and make more money. And they have $200,000 of liabilities. So their equity is $800,000. So we pay $1 million for this business. So we give the $1 million to the current owner, and then that's not part of the new business. That's his money that he can do whatever he wants with it. The current owner can use that money. He might split it with other owners. I don't know if he has to pay off debts, his personal debts, but we don't care what he does with that $1 million. He gives us whatever's on his balance sheet. So our new balance sheet is going to be this $1 million and this $200,000. So we paid $1 million, but we only got $800,000 of hard assets. Net assets. The net assets equals assets minus liabilities. So we paid $1 million, but only got $800,000 of net assets. So where's the other $200,000? Why do we overpay for this company? If we're getting $1 million of, say, this property, plant, and equipment, which is what we want, that's why we acquired them, and then we get $200,000 of, we take on their accounts payable, how much they owe their vendors. So we take on some of their debt. That's part of an acquisition. So we get $800,000 of net assets. Why do we pay over $200,000? You have to account for that, and that's called goodwill. That's the premium you pay when you acquire another company. So we paid $200,000 more than the company's worth. So we would add on our balance sheet in the asset section goodwill for $200,000, and that's how our balance sheet balances. So even though we didn't have much of a company, we just had, before the acquisition, we just had one asset, which was cash for $1 million. So we removed that cash, and then we added this $1 million of property, plant, and equipment, and $200,000 of liabilities. So we're not balanced. We're off $2 million because we minused $1 million of cash. So from this transaction, this acquisition, our cash decreased $1 million. Which is an asset. Our assets decreased by $1 million. Then our assets, which is PP&E, increased $800K. And then our liabilities increased $200K. So that was the transaction. So it doesn't balance. So in order to get the balance sheet to balance, we have to do, it's just a plug. It's a meaningless asset. It's called goodwill. And it's just to get the balance sheet to balance. And goodwill is not an asset you can sell in open market. Every time I think I understand. Every time I think of a good way to explain these things, and then when I try to explain it, I don't think it's that as clear as in my head it is. Is it clear? Because in my head I'm like, okay, this is a good way to explain it. I guess maybe it's easier if I show you an actual example that the company acquired, because they do talk about in a 10K or 10Q the acquisitions. But that's pretty much what goodwill is. It's what you pay above what the company's worth, which is a very common thing. A lot of companies pay above what the company's worth. Most of the time when you acquire a company, you wouldn't pay less than they're worth. Like if company X, they wouldn't sell themselves for $700,000 because they're worth at a minimum $800,000. If you assume the assets are good assets, are actually worth $1 million. The thing is with goodwill, you may actually, write down the goodwill in future years if say we ran our new company for a couple of years, and we actually didn't feel the assets we acquired from company X were actually worth $1 million. We just felt like we weren't making as much money as we thought with this acquisition. You could pretend we acquired many companies. So we're looking at each company we acquired, maybe company Y we acquired, and that's doing really well. So that was a great acquisition. But company X, we're like, we're not even making that much money on their products that we're selling. So yeah, so then the $200,000 of goodwill, which is an asset, you might reduce it. You say, actually, I think we should just knock it down to zero, because I don't think it's worth anything. We're not making much money with this acquisition. We're not selling much of their products. Let's just reduce it to zero goodwill. And that means you have to pass through a goodwill impairment on your income statement, which decreases your net income. That's how you get it to balance. When you decrease goodwill, you have to then pass through an expense on your income statement to reflect that decrease. But that happens a lot. That happened. Who acquired AOL? Okay, AOL was acquired by Verizon for $4 billion. No, I'm not thinking. It was what was the flip phone? What was the flip phone called? Who acquired flip phone company? I think it was Microsoft. They acquired a company, and and Nokia. No, what Motorola? Was it Motorola? Who? I don't know what I'm thinking of. What phone company did acquire? Oh, what? It was. Okay. So Nokia was acquired, at least the phone division of Nokia. Nokia is still an active company. They're a pretty good company. They have a lot of software that goes into phones and other electronics. But they sold just their phone division, the Nokia phones. And I think Microsoft, that was a huge write-down. Let's see if they talk about it. Write-down. Yeah, they acquired Nokia for like, I don't know if they acquired it for $7.6 billion. But it ended up they never really made much money from Nokia. Like when you acquire a company, you expect, like if you say you wanted to buy a friend's company, it doesn't matter what type of company. Say you own a laundromat and you make $100,000 a year in profit. And then your friend owns a laundromat in the next town. And he says, I think I'm going to retire after this year. Do you want to just buy my business? And he's like, well, how much profit do you make? And he says, I make about $50,000 a year now. I used to make more, but I'm not open as many hours. So $50,000 profit. So you said, okay, I'll give you $75,000 for your business. But it's possible after running his business, you're like, his customer base is dwindling down. Most of his customers are actually going to your store in your town. So you don't make much of a profit. You ended up making like 10,000 profit from his business, even though he was making 50. So it turns out to be not a great acquisition. That happens a lot. Like Microsoft wrote down $7.6 billion from Nokia. They cut 700 jobs because Nokia phones seems like a good product when they bought it, but they can't compete with Apple. So these things happen. Let's see. Microsoft CEO didn't waste any time dropping the company's previous focus on devices and services after his appointment. In recent weeks, former Nokia CEO departed Microsoft. alongside the company's head of phones, Joe Harlow. Tough choices in areas, and the peers were seeing the first major signs. 7,800 jobs. So they tried to get into selling phones, Microsoft, which makes sense. You want to compete with Apple. It's kind of like you're kind of neck and neck with Apple. You do a little different things, but there's a lot of similarities, and you want to compete head on in the phone business. It's a huge business. But so they acquired Nokia, and they ended up not. It wasn't a good acquisition, unfortunately. So they just wrote it down. I think that's clear, right? That makes sense. SR. That's my initials too, SR. Good to see you. Is this your first time on the stream? So another thing I like to look at is RSI, Relative Strength Index. And if it's over 70, then it's probably considered overvalued. Let me talk a little about RSI. So the Relative Strength Index it measures the speed and magnitude of a security's recent price change to figure out if it's over or undervalued. And it's between a range of 0 and 100. Alex, what's up? The indicator was developed. The RSI can do more than point to overbought or underbought securities. It can also indicate securities that are primed for a trend reversal or corrective pullback. So usually, the standard is if it's above 70, don't buy it, or short it maybe. If it's below 30, then buy it. It says that right here. An asset is considered overbought if it's above 70, oversold when it's below 30. I look at short interest, institutional holdings, shares outstanding, forward PE. No, that's good, horse, a bird. I look at most of those too. But let me know what you do. Because the thing is, when you look at just one thing, it's kind of meaningless. You have to combine it with a lot of different things. So it even says that the RSI works best in trading ranges rather than trending markets. Okay. So it combines not just the stock price, but also the a lot of other things like the average gain, the average loss. You can see the calculation is 100 over 1 plus the average gain over the average loss. So it does give a little more information. I prefer a slow stock to RSI. That's interesting. Let's look at that, slow stock. I like volume too because it gives it's kind of tangible. Which stochastic one do you use? The fast, the full, or the slow? I don't even know. I would just use Investopedia because it's very clear. It kind of explains things really well. Stochastic is a momentum indicator comparing a closing price of a security to a range of its prices over a certain time. The sensitivity of the oscillator. So same thing, 0 to 100. Stochastic oscillators tend to vary. around some mean price level since they rely on the asset's price history. 80 indicating that an asset overbought. So it has a similar range. This says 80-20, RSI 70-30. So here's the calculation. It's C, which is the most recent closing price, minus L14, which is the lowest price traded in the previous 14 trading days, over H14, the highest price during the last 14 trading days, minus L. Yeah, there's some similarities. But the good thing about looking back is that you can identify like which indicator would have worked better. Because you see, what's the difference between the orange stochastic and the red? Is that just the red's like an average of over time? Because they move together. So if you follow it got pretty low stochastic. See this blue line, that's kind of like the point when it falls below that blue line is when you should buy it. Same thing with RSI. This blue line, when it falls below it or touches it or gets close to it, is the buying point. The problem is that it could stay, like these indicators can stay low for like a few months, or they can stay high for a few months. So if you're interested in options, that can be tough, because if you bought options on NVIDIA back here, you can see it traded in a tight range. The only time you would have like nailed it with options is if you bought it like in January 2024, like if you bought 3-month options, or February, because it shot up so fast. Or if you buy options on the other direction, if you got it up here, if you bought puts, and you have to really time it well. It's kind of hard. NVIDIA is overpriced and ready for a pullback. It's absolutely overpriced, and it's definitely ready for a pullback. But we remember Tesla. We said that for like 6 years. Now it's pulling back, but who knows when? And remember Michael Berry? He lost billions on shorting Tesla, because I mean he was right, but it's just like if you're not right on timing, it's just like you can never make it up. But yeah, it's the most abnormal growth of a stock ever. NVIDIA, like no stock has went from 1 trillion to 2 trillion. Only 2 stocks ever went from 1 trillion to 2 trillion before NVIDIA, Microsoft and Apple, because there's only three stocks ever that hit 2 trillion. So only 2 stocks ever went from 1 trillion to 2 trillion, but they did it in like a month, a trillion to 2 trillion. It took like Microsoft and Apple, a decade to go from that point. Yeah, Tesla is down 40% and dropping. Yeah, we all knew it would come down, but the thing is, I remember my friend made a ton of money on Tesla. He kept buying in like he had it at $20 a share as cost basis, like in 2015, 16, and then he bought more at $100 a share. So he made like a couple $100,000, which was 90% of his portfolio. And I kept telling him to sell, and he kept ignoring me. But it was good because I kept telling him to sell, even over here, even when it dropped here, but then it went back up. but now it's coming down. But it's not that low. I mean, it peaked at 400, and now it's half of that, which on a percentage basis is kind of sounds low, but it's still $558 billion valuation, which is like, let me show you the other. Because car manufacturing is not a sexy, lucrative industry. You know what's sexy and lucrative? Like credit card processing, very lucrative, high margins, very low expenses to get into other locations. You can scale all over the world very easily. Auto manufacturers just generally aren't so that's just why. But people aren't looking at this company as an auto manufacturer. They're looking at it as a technology giant. Well, Toyota, is that right? 329 billion? Is that high, Toyota? Wow, I didn't realize it was so high. So maybe it is 596 isn't too out of the question. Because I'm thinking about like Ford and GM, like how it's 10 times the size of Ford and GM. Honda's 58 billion. Ferrari, which is just a specialty brand, race as Ferrari. So that could be worth it because it's a little different. Stellantis. That's still up there, 82 billion. Well, they have a lot of sales. I still see Tesla having more downside from a technical perspective. Good chance of a bounce here, though, short term. My last valuation on it, 113. Yeah, let's see. Because if you want to compare companies, it's hard to compare with different market caps. That's what the price multiples are for. So let's see on a PE, price to free cash flow, and price to sales. And companies, Amazon was like this too. They were trading at like 500 times earnings for a long time. They were so overvalued, and people were like, "Oh, Amazon, it's gonna come crashing down," but it never really did. It just kept going up. It's hard to read with these big numbers. Okay, this is easy to read. Okay, so it's actually it's trading at 6 times revenue, which doesn't look too bad. What's the median? Because when you do averages, like this 1300 will skew the average. So median, the median's 2, so it's let's get rid of these under 1 billion. I hate they include negatives. It's I mean, if you want a good investment in a car manufacturer, I think Toyota is the best. And look at that, they're trading at 1 times revenue. So that means their revenue is equivalent to market cap. Tesla 6 times revenue. Ferrari, which is a different animal because it's a specialty brand, and people wait years for a Ferrari, and they pay a lot of money. So it's a little different type of investment. It's not as much of a commodity as a Ford or GM or even Tesla. You get Tesla for under 50,000. Oh, what the hell is NWTN? I guess let's ignore anything under $1 billion market cap. It's just noise. These negatives really mess things up because you can't have a negative PE. Look at, well, they're trading at less than 1/2 revenue. So that's how undervalued and how people are not willing to invest in Honda, GM, and Ford, because they're all trading at below 1/2 of 1 times revenue. That's when you know you have a problem, is when you are generating a lot of revenue and people still don't want to buy your stock. Like Ferrari, people are willing to pay 11 times revenue, 50 times free cash flow. So they're trading at worse multiples than Tesla, except for price to free cash flow. They're generating more free cash flow as a percent of their market cap. Stellantis looks pretty good. They're also trading at less than 1/2 of revenue. And they have a bunch of, right? Stellantis has a bunch of brands. Yeah, they have Chrysler, Dodge, Fiat, Maserati. So they have a lot of big brands under them. They're kind of diversified pretty well. But I mean, it's improved a lot. Remember, I mean, Tesla for a long time remember there was like 1,000 times earnings they were trading at. So they've improved a lot, their price multiples, because their stock has come down a lot, and they're starting to earn. They're more profitable. For years, they didn't have any profits, but lately they've been putting up pretty good numbers. I mean, look at their revenue, 30, 50, 80, 90. And then their earnings, it went from 700,000 to 5 billion, 12 billion to 15 billion. So they've grown into their earnings. What I was going to say before is, this is generally how, let's say on January 1st, okay, price. Okay, this is generally how companies' stock prices move. It's a real kind of high level, but say a stock is it's $50 a share. Okay, on January 1st, and 1Q earnings, they're going to report first quarter earnings on April 15th. Generally, I think the average is 6 weeks after the quarter ends, a company reports their earnings. Some companies do it like 4 weeks after quarter end. Some companies do it 2 months after quarter end. I think the average is like 6 weeks after quarter is closed. Then the company reports their earnings. That's why you see a lot of companies report earnings. 6 weeks after 3/31. So it's May 15th. Because first quarter earnings is 1/1 through 3/31. That's their earnings for first quarter. So, like, what was their revenue between 1/1 and 3/31? What was their profits? Everything. So first quarter earnings. So most companies would report it 6 weeks when the quarter ends. So May 15th. So if if investors think they're going to have 1 billion of revenue, 100 million of earnings for the quarter, say that's the target. Now the stock price, if investors think they're going to hit these targets, the stock price usually is pushed up. Because sometimes people think, like they do with NVIDIA, they think, oh, they're going to crush these targets. I think they're going to probably do 1.2 billion of revenue and 130 million of earnings. If they think they're going to crush the targets for the quarter, then you see the stock price, on January 1st, it's 50, then it's 55, then it's 65. And then as it gets closer and closer to earnings, depending on the market sentiment, of course, if the sentiment is they're going to crush earnings, and if they actually do beat earnings, because the market's thinking, if the sentiment in the market is like they're probably going to get 1.2 billion and 120 million of earnings, and they do get that, or really close to that, then there's usually a sell-off, because people feel they take in their gains pretty much. It hit that target, because investors know they don't wait. Investors don't wait for them to actually report these numbers. It's all built into the price, and then when they hit these numbers, a lot of people who were banking on this take the profits, and then the stock comes down to like 67. So it was 50 in January, and it got pushed up to 80 right before earnings. Then it came out 67, and then there's investors who always say, "I don't understand. They hit their target, they beat their earnings target, but the stock still came down." They're like, "I don't get that." Because they hit their target, or at least the market sentiment was actually they were going to hit it, they were going to break it. If the market sentiment was if they actually hit what the market thought, they thought they're going to beat it, not just hit it, it would actually come down. Let's just pretend they got even higher, like people were talking about 1.2, and they ended up getting 1.3. Then it would get pushed up even higher. So then it would go from 80 to like 87, because they didn't. They beat the analyst estimates, and they beat what the street thought too, because there was a lot of talk. Just like when Nvidia, people were like, "Oh my God, they're gonna crush it," and they did. And that's why the stock went up so much. But the worst case scenario is that there was a lot of everything baked into price because it got up to 80. So the street thought they're going to crush earnings. Like they thought they could hit this 1.2, 1.3. And if they just hit earnings, they just got their 1 billion, which is what the company said last quarter they would do. That's how the street knows about this, because each company usually gives a forecast for the following quarter and following year. So if they just hit these earnings targets, the stock would come down a lot because it got pushed from 50 to 80. And it got pushed up so high, not because the street thought they would hit it. The street was banking on 1.2, 120, just because, I don't know why, but for whatever reason, maybe other companies were beating earnings in their industry. So they pushed the price to 80, but they just hit their earnings. So it comes from 80 all the way down to like 57, which is just a little more than January's price. So it's not like it's down that much, but it came down quite a bit from 80. And then there's these new investors who are like, I don't get it. They hit their earnings. They hit the analyst estimates and the stock came crashing down. I bought in at 70 because it kept going higher and higher. I bought at 70. So this is generally how it works, because it's confusing why a company hits their earnings target and it goes down a lot, or even beats it sometimes by a little. But the other thing is they then give you a forecast for the next quarter earnings. So they'll say, okay, this quarter we got 1 billion, 100 million. So we did hit what we said we were going to do. And next quarter we're going to do 1.6 billion and 150 million. And if they do say that, then the stock might actually go up more instead of going down to 57. Because the stock price usually moves with two things. What they actually reported for earnings and what the forecast is for the future. So if they give a really rosy future forecast, then the stock may go way higher, like Nvidia did. But that's why Meta kept coming down, because their forecasting for the future was low. Remember, like in 2021 and 2022, the stock price kept coming down because they were cutting forecasts and they weren't as profitable, I guess, for the metaverse, and they had too many employees, but they fixed that. So I'm always curious how much of the stock price growth is coming through the QQQ SPY ETF inflows versus the actual revenue shorter term. You mean people buying like those ETFs versus actually people buying the stock? I don't think it has that much influence. I'm not sure, because I know I've seen companies enter the S&P index and the stock price actually went down sometimes. Maybe because it was already built into the price. But yeah, I don't see that being a huge impact. If a company does get put into the S&P index and it goes up a lot, I think oftentimes it was coincidence. Like they happen to be put into the S&P index and the stock was it was a buying spree. People kept buying the stock. It's kind of like when a company offers, like remember when, I don't know what Costco stock did, but remember when Costco offered a special dividend of $10? Like when a company offers a dividend, say they offer a dividend of 1% of the value of the company, Then the stock, and say the stock is trading at 100, and the dividend was equivalent, the amount of dividends they're paying was equivalent to 1% of the company's value. So the stock mathematically has to go down 1%, because when a company pays a dividend, the stock goes down a similar amount as a dividend payment, because they're taking cash out of the business and giving it to you. So it has to go down equivalent, but it never does, because there's market forces that influence the stock. So if a company pays us a big dividend and investors are unhappy with the dividend because which is probably not going to happen, but if they think, okay, they shouldn't be paying a special dividend because they're low on cash. I'm not talking about Costco, but say a company paid a special dividend, and investors were unhappy because they were losing cash flow and they needed the money to grow the business. So investor sentiment was pretty weak on them paying a dividend. So the stock should have went down from 199 from the dividend, but it ended up going down to 95 because investors were not happy that they paid a dividend when they should be using the money to grow the business. Or it could be the opposite. A company can pay a dividend of 1%, and a stock should go down to 99, but it ends up going up to like 113 because you have like a huge influx of investors. I think that's what happened with Meta. Meta mentioned they're going to pay their first dividend. And what happens when a company mentions they're going to pay their first dividend? Usually nothing. But with Meta, there was a lot of people who wanted to be part of Meta, but people for some reason in their mind, they just will not buy a stock that does not pay a dividend. They just can't do it. That's just how they don't feel comfortable. They feel like they're throwing money away. They feel the only way they're going to get money back is a dividend. But that's fine, because everybody's different. They're entitled to their own opinion. So you have this huge influx of people that came in to buy Meta because of the dividend, because they always wanted to own Meta, but they didn't pay a dividend. So, but that's market dynamics for you. Supply chain issues, geopolitical issues, regulation, race, gender, lawsuits, unionized labor, high interest rates, record debt. If you buy Volkswagen now, you pay for the stake in Porsche and all the other. If I had to buy an auto company, I always thought Toyota has the best cars and the most efficient business. So what other company? Ferrari. Oh, here it is. Let's see. The most recent earnings, they reported 175 EPS. The estimate was 160, so that was a 9% surprise. Revenue, a small surprise. They just beat revenue, but a huge gap up. Well, look how much Ferrari has gone up. It's well over 400. So in 6 months, it's up like 30-something%. That's a good stock. Well, I never bought it. I'm not, but it seems like a good stock. Like, it does well. They pay a dividend too. Let's see the stochastic and the RSI. So RSI, you can see this pink, it's filled in with the pink. That means it broke through 70. And that's kind of like, that range is like, don't buy it, don't buy it. This range, it also broke through 70. See, this would have been see when it broke through 70, which was right here, that would have been a bad time. That would have been bad information, because it's saying don't buy it, but look where it went. So here it was saying don't buy for a few weeks. So in the beginning, you should have bought it, but then by the end, it hit its peak. So I guess you should have listened to this. I guess it's the same thing with the stochastic. I want a new AWD Camry. I got a Camry last year. I owned a BMW for a long time. My very first car was a Camry, 89 Camry. I really liked that car. And then I got a BMW when I graduated college. I had it for 20 years. And then it was just getting too expensive to maintain because it was so old. Toyota also owns stakes in Subaru, Mazda. Toyota owns Lexus. So Toyota is a great car. I think it's the most popular car in the world. Maybe Honda Civic. Either the Camry or the Civic is the most popular car in the world. But they have high-end cars. Like they've had the Lexus for a long time, which is a high-end car, which is equivalent to like a Mercedes and BMW. So the stochastic it looks very similar to the RSI. It also has it above 70 for the whole month of November, which would have been a bad call because if you listen to these, you would have said, above 70, I'm not buying. But look where it is now. I guess it did come down to like the 40s. So it was saying buy. I'll be right back. Well, just put it on the side. I'll do it one shot. Okay. And I spent a ton on racing. Okay, so let's try to go back to these charts. Is any stock anybody want me to look at now? We could try to look at these indicators to see if we can identify things we should have done. Let me know in the comments if there's a stock. Well, if anybody wants to be part of this live stream, you can be a guest. The thing about these indicators, it's more of a short-term thing because they move up and down, up and down. So if you follow these indicators, it's kind of like you buy it here, then you sell it here, then you buy it here. It's not like the way I usually invest is like you buy it and you hold it for 20 years. I mean, I've never held a stock for 20 years, but I have some since 2017. What website? Oh, Paul, yeah, I use Finbox to get the whack. It's a free website too. You put a ticker in. You do have to pay for some of these features, but to look at the models, I just go to models and I go to cost of capital, and it gives me a range of WACs. I used to calculate the WAC on my videos, but I just get it from here. It's pretty easy to calculate. So Cigna, the medical insurance company. It's a big company, Cigna. Medical insurance is a huge industry. Insurance alone is a huge industry. They do medical, dental, disability, life, and accident insurance. They do a lot of things. I know them as medical, but yeah, I never use them for other things. But Cigna offers Medicare and Medicaid. See, Medicare and Medicaid are a big industry because it's subsidized by the government. You prefer a WACC over ROE, return on equity? Yeah, I mean, there's a million ways to skin a cat. Wow, it's really, really volatile. I didn't realize how volatile. You can't even see these charts. Look, it started trading before most of us were born. I mean, not before I was born. 82 started trading. 82. But for the longest time, stocks didn't move that much. They did move, but like now they move like crazy. The volatility is just crazy. There's so many investors now, and people have access to websites, and they didn't in the past. So they can buy tons of stock in one time, and they can buy quickly, and they could set up all these, stop losses and all these crazy things. Where in the past, it was you can do those things. It was just hard to do it. You had to like fill out a form. You had to call someone up. It was just a lot more cumbersome. But I mean, it's better. It's great to have more investors, more money in the market. So it's definitely trading at a really high level. It really came down here. It must have been bad earnings. They reported 474 EPS versus what the market thought, 543. So 13% negative surprise, which is not good. So that was. So you can see, like I was talking about before earnings, how it seemed, not in every situation, but it seems like most situations is that you see he has the E to E. After a month after earnings, the stock settles in to where it belongs, right? And then investors need to figure out, will they beat earnings, which is here, or will they miss earnings? So you can see investors really thought they're going to beat earnings, because look how much the stock had go up for the next 2 months, from September to November. it went from 280 to 318. So it went up about 10% in 2 months. So investors really thought they're going to beat earnings, which is pretty common. Most of the time, investors think they're going to beat earnings, so the stock price gets pushed up. It's assumed they're going to beat earnings, and then once they report earnings and they miss, it comes crashing down, the stock, and then it eventually settles in. There was a huge gap up. I'm not sure why. We can try to figure that out, why there's a huge gap up. And then it settles in over here, finally, after the huge sell-off. It settles in here. And then it's kind of flat, so that there's not much optimism they're going to beat earnings. It goes up a little bit, comes down. And they didn't. They missed by 34%. They did beat EPS, not GAAP EPS. So maybe investors were happy they just beat regular EPS. And there was a huge run up. Why did it go up from 305 to 341? A Kramer-esque light round? What does he do? I watch him, but what does he do? He just talks about stocks for lightning round? 90%. What is it, like 95% of gaps get filled? So this gap up, it never got filled because it hasn't come down to this level yet to fill up the gap. It just kept going up. There was a gap up here, and that hasn't gotten filled either. So if you follow these stock charts and you believe in these things, this is going to come down to like 260. At some point this year. I'm not saying, I don't know, by the end of the year or 2025. I don't know what's going to happen, but based on these charts, it should at some point touch I'd say the 270 range. That's probably it's a resistance point, at least for this stock. Because if you look historically, I wish they made it easy to read these charts. They're kind of lumpy. It's hard to tell with so much data. But the gaps usually get filled. SR, thank you. I appreciate the sticker. It means a lot. But let's just look at the yeah, no problem. So right here, it was under 20 on the stochastic fast. It wasn't that low for the RSI. It was in the mid range, like around 50 for the RSI. So this was a good buying point. And then when it got up here, it was like sell, 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 really high RSI. So it was a constant sell. But you can't sell like every single day. You know, I mean, you got to hold for a little bit, right? So these indicators look like they make sense, right? Because it kind of follows the trend of the stock. What's another indicator? Well, volume, I guess. The MACD. I wish they had like a short interest. It's the moving average convergence divergence indicator. Let's see the calculation if they have it. They don't have the calculation. Okay. Okay. Moving average is a technical indicator to help investors identify market entry points for buying or selling. Okay, it's calculated by subtracting the 26-period exponential moving average, the EMA, from the 12-period EMA. The signal is a line period EMA of the MACD. MACD is best used with daily periods with traditional settings. Okay, so it's based off of the moving average. The moving average, it does smooth out your average because if there's a lot of like ups and downs, it kind of smooths out the numbers. What's a good MACD? Oh, here's the calculation. Yeah, 12-period EMA minus 26-period EMA. So what number MACD is? What do people look at? Like, what's the? Oh, it depends on the stock. So this, are we still on Cigna? Yeah. Okay, so Cigna was really overvalued according to RSI for most of February. And then, yeah, so pretty much all of February, it was overvalued. Same thing with the stochastic. The MACD, I'm not sure what it's telling me, the MACD. What? What is a good MACD value? Oh, it's the same thing. Above 70 is overvalued. Below 30 is undervalued. So it's the same thing as the other two. Okay. But this is 5 and 6. So I guess if it's high above the blue line, that means it's a sell. You don't buy it. And if it's below the blue line, like here, is you buy it. So yeah, so I guess they all tell the same thing. It was a buy at the end of December, which is accurate because it was low. And then it shot up. I mean, in this case, it would have worked out great because look how much it's gone up. But there's a lot of stocks that go up and then come back down. Let's see what Tesla is like. Okay. Okay, so Tesla, let's see. Okay, so like you can see the RSI got low in August 2023. Stochastic got low, and also MACD got low. So that's indicating a buy. So if you would have bought it, you would have had to sell right away because it came back down. It did come up, but then it came even lower. So you would have lost a lot of money in this case. So you couldn't hold the long term because Cigna would have worked out because Cigna kept going up. But But Tesla, if you got it down here, which would have been a good buy according to these indicators, but you had to sell like a month later. If you didn't sell, you're down like 30%. And I think if your cost basis is above 200 for Tesla, I'd say just give it up. Just throw it away and buy good stock, because this is going to be a volatile stock for the rest of time. I don't think it should be a $500 billion stock. I think in the long run, I think the company will be around. I think it's a good company, but just like I think Ford is a good company too, but they're just not that profitable. It's hard to make money. It's kind of like an airline. It's just hard to make money, be profitable. It's a tough business. Okay, so ideally a bullish cross up at the 0 line. Okay, I see what you're saying. This is the 0 line. So when it comes up above the 0 line, that's a bullish. Similar to these, when it gets high above the line, well, the purple line, it's a buy. When it gets below the line. But it's hard because if you, I guess if you sold up here and then bought down here, but it's pretty much you'd have to constantly buy and sell. Like in Tesla's case, because if you just waited, it did come down. Unless you bought it before this point, like down here. See, I wonder if people actually make money. I don't know if people really make money doing this. I think they get lucky once in a while, but like it's hard to, because it's almost like you put in 100K and then you get like 150K, and then you put in 150K. Eventually you can't. It's like you have to keep winning, because even if you have one loss, like a 70% loss, that could wipe out like your portfolio. It's kind of like roulette. I feel like, you put 100, you choose black or red. Say you choose black every time or red every time, whatever, or combination. And it's 50-50. So if you put let's just pretend you chose black every time, and just assume it's 50-50. I know it's not. I know, because there's a couple of green, the 0 and the double 0. But just pretend they took the greens away, so exactly 50-50 every single time. And you chose black. So if you put 100 on black, there's 50% chance you would double it to 200. And then if you put 200 on black, it's 50% each time, but the probability of hitting 2 in a row is 25%. So if you play this game and you said black. You put 100 black, you got $200. Black again, $200. So there's 25% chance of that happening, hitting it twice. It's a 75% chance of not hitting it twice, either missing it twice or win loss win. And then 13% chance of black 3 in a row. So you're 800. 6% chance. Oh. It's kind of like that with investing. I feel like if you keep, for day traders that is, if you keep putting all your money in, eventually there's going to be a stock that just loses everything or goes down a lot. So you can't keep winning every single time. Yeah. Okay. So you say MACD and RSI winning combo. But how long do you hold for it? I understand if both indicators are saying buy, like they're real low, buy. So do you then ride it up, and then once the indicator gets to, well, never hit 70, what do you do? Like, when do you sell it? That's the thing that doesn't make sense to me. I do see the indicators, but if like a week later the indicator is like almost 70, then do you just sell it again and then wait a couple months, it comes back down, then you buy it? I guess you could have all these kind of different indicators and ways to identify when to buy and sell. Like I totally get it, and I think these do make sense. It's just that, like, eventually you're gonna get pinched, and it's just not gonna, you're gonna get the wrong time. Like, eventually you're gonna buy it at the wrong time. Like, let me see if I can show you in a longer chart. Like, if you buy here, for instance, no, it's high. Okay, if you buy here, it's low. So you pick it up here at 229. And unless you sell here, but if you miss this, this month of selling, it never came back to this point. I mean, you could sell at a small loss around here. I made out good with some mining stocks. Yeah, we always have success with a trade or two, but it's hard to consistently do it. Make these big profits on trades, or any profit at all. It's okay. Well, it's an interesting stream. Good. It's good to look at these try to understand it better. Yeah, that's a good way, Paul. I agree. It's a frosting on cake. Just look at the fundamentals, and you can use it as maybe an entry point or an exit point, I guess. But okay, I'm gonna sign off now. I gotta work in the yard on something. Okay, I might go on later. I gotta see. But thanks for joining. Thanks for talking, everybody. I'll talk to you later.